Imagine you've just finished, this really incredible luxury dinner at a high-end restaurant down in the Dubai Marina.
Oh, nice.
Yeah, the waiter brings the check. But you don't reach for a platinum credit card, and you aren't tapping your phone with Apple Pay.
Right.
Instead, you scan a QR code on the bill, and you settle the entire balance using a decentralized network named after a tech CEO's pet cat.
Yeah, it just sounds entirely surreal. I mean, if you told someone a decade ago that an internet meme would evolve into a financial settlement layer for luxury hospitality,
they would have laughed you right out of the room.
Exactly. They really would have. But we have a massive stack of crypto exchange data, project roadmaps, and market analyses sitting right in front of us today, proving that this is, well, a documented, functional reality.
And that is exactly why we're here. Welcome to the Deep Dive. Our mission today is to unpack the evolution of Toshi, ticker symbol TOSI.
It's a wild story.
It really is. This is a digital asset that started its life as an inside joke. But today, it is attempting to rival giants like Dogecoin by building serious, decentralized telecommunications and financial infrastructure.
Yeah, the leap from a joke to actual tech is what makes this so fascinating.
So we're going to cut through all the hype and the noise today and figure out exactly how a cartoon cat goes from a browser window to an actual cellular network.
To really understand the mechanics of how this happens, we first have to establish where Toshi lives, right?
The foundation.
Exactly. It was built on a network called Base. And Base is what is known in the industry as a layer 2 blockchain, which was developed by the cryptocurrency exchange Coinbase.
Okay, let's translate that layer 2 concept for anyone who isn't, deep in the technical weeds every single day.
Sure, that's a good idea.
Think of the main Ethereum network as this massive, highly secure, but heavily congested toll highway. Yeah. When traffic is bad, the tolls, or what crypto people call gas fees, they just skyrocket. So basically operates as a high-speed, low-cost express lane built directly on top of that highway.
Yeah, that's a great way to look at it.
You get the underlying security of Ethereum, but your transactions cost pennies and settle in milliseconds.
And that speed and low cost, they are critical to this whole story. I mean, meme coins are almost universally dismissed by traditional financial analysts as purely speculative digital gambling.
Just people passing a hot potato back and forth.
Exactly. But Toshi serves as this really compelling test case. It challenges the assumption that these communities only exist to trade tokens.
Because they actually build something.
Right. It shows us the underlying mechanics of what happens when a highly engaged, totally viral community decides to build actual software.
But we need to look at the anatomy of how that identity was actually formed first, right? Because you don't just get to build telecommunications networks unless you have an army of people who trust you.
No, you definitely need that social capital first.
So Toshi launched in August 2023 on this new Base network. And the name itself is essentially this layered cryptocultural artifact.
It operates as a dual tribute, really. Toshi is the actual name of Coinbase co-founder Brian Armstrong's real-life pet cat.
Which is funny on its own.
Right. But the cat itself was actually named after Satoshi Nakamoto, the pseudonymous creator of Bitcoin.
So it's a crypto inside joke wrapped in another inside joke.
Basically, yeah. So before a single line of infrastructure code was even written, the token possessed this built-in cultural resonance. It instantly appealed to crypto natives who are exploring the Base network.
But I mean, clever branding only gets you a few days of attention in this market. People move on so fast.
They do.
So they backed up the internet culture with a highly unusual approach to their tokenomics. They launched with a maximum supply of 420.69 billion tokens.
Which is, of course, another obvious internet joke.
Right. But the distribution method is what actually matters here. They used a fair launch model, so there was no pre-sale for venture capitalists.
0 tokens allocated to the founding team.
Exactly. 100% of that supply was put into circulation immediately.
And I have to point out, that is a severe departure from the standard playbook in this industry.
Oh, completely.
If you look at a typical tech startup, or even most modern utility crypto projects, the founders and early investors always retain massive portions of the equity or the token supply.
So if we think about the incentives there, it's honestly kind of baffling at first glance.
Oh, so?
Well, if the creators didn't keep a massive stash of tokens to get rich quick when the price spiked, what was the actual mechanical incentive for them to keep writing code and building the project after that initial launch hype wore off?
That's the core question, right? And the answer is that trust is a highly monetizable asset in decentralized finance.
Okay, unpack that a bit.
The zero team allocation and fully circulating supply, those were structural mechanisms designed to eliminate the fear of a rug pull.
And for you listening, a rug pull is basically when anonymous founders artificially hype up a token, they wait for retail investors to pour their money in, and then boom.
They suddenly sell their hidden stash.
Right, which completely drains the liquidity and crashes the price to absolute zero.
Yeah, it's devastating. But by mathematically eliminating the team stash, Toshi physically prevented that specific scenario from happening.
And then they doubled down on that trust building later, right, in October 2023.
Yes, the community actually held a vote and reduced the transaction tax to 0% for both buying and selling the token.
Which is huge, because prior to that vote, there was a 3% tax levied on transactions to fund ongoing development.
Right. And scrapping that tax was a profound shift in mechanism. I mean, centralized crypto exchanges absolutely despise transaction taxes.
Because it messes with their books.
Oh, it completely wreaks havoc on their internal accounting ledgers. So by moving to a zero tax model, Toshi removed the primary technical friction that was preventing them from being listed on major global exchanges.
And those listings are what invite much deeper liquidity pools. So once you have absolute trust from hundreds of thousands of holders, you effectively have a captive audience.
You do.
But digital ecosystems have a hard ceiling if you don't actually provide a service. So Toshi pivoted.
They did.
Instead of the cliche selling shovels during a gold rush analogy, let's look at this differently.
Okay.
If the base network is a brand new, rapidly expanding digital city, Toshi didn't just try to be a popular tourist attraction. They decided to become the city's zoning board, the plumbing union, and the construction company.
So everyone else could build their businesses on top of them. That's a great analogy.
Yeah, so how do they actually execute that?
They did it by launching a software suite called Toshi Tools. This was a really clear transition from being just a social token to an actual infrastructure provider.
Right.
And to prove the underlying code was sound, they submitted these tools for a rigorous audit by Hellborn,
Which is a major, highly respected blockchain security firm. You don't just pass a Hellborn audit by accident.
Exactly. It proved they were serious.
So let's break down the mechanics of these actual tools from our sources, starting with the Toshi Mart.
Sure. Toshi Mart basically operates as a one-click social launchpad.
So if a developer has an idea for a new token,
They don't need to write complex smart contracts from scratch. Toshi provides this frictionless, standardized platform to launch it securely.
okay, and then you have lockers, specifically token and liquidity lockers.
Right, and to understand why these are vital, we have to go back to that fear of the rug pull we talked about earlier.
Right, the developer's running off with the funds.
Exactly. A locker is essentially an unchangeable digital vault. Let's say a new developer launches a project on Base. They can deposit their team's tokens, or those critical liquidity pool tokens that allow trading to happen, directly into a Toshi locker.
The smart contract physically takes control of those assets.
Precisely. The developer sets a cryptographic timer, say 2 years. Once it's locked, the code literally prevents anyone, even the original creator, from withdrawing those funds until the timer hits 0.
Wow.
Yeah, it allows a brand new, totally anonymous developer to cryptographically prove to their investors that they cannot steal the funds, even if they wanted to.
So Toshi provides that layer of verifiable security for the broader Base ecosystem.
Yes, exactly.
They also released a multisender tool, right?
Yeah, this one is very practical. Let's say a developer wants to send a promotional airdrop of their new token to, say, 10,000 different wallets.
Doing that one by one on the blockchain requires paying a separate gas fee for every single transaction.
Which would easily bankrupt a small project.
Right.
So the multisender bundles those transfers mathematically, it executes them simultaneously, and saves massive amounts on network fees.
Okay, but all of this infrastructure raises a pretty critical question about token utility.
Go on.
How does the existence of these developer tools actually benefit the retail investor who is just simply holding the Toshi token in their digital wallet?
Well, they created a very direct tiered utility system.
How does it work?
If you hold 1 million Toshi tokens in your wallet, you are granted free access to use all of these developer tools.
Oh, I see.
But if you don't hold the required amount of tokens, the smart contract charges you a fee of 0.01 ETH to utilize the suite.
And depending on market fluctuations, 0.01 ETH can be roughly $30 to $40.
Right. So by forcing developers to either buy and hold Toshi or pay a toll in Ethereum, they created continuous underlying demand for the token.
Because Base is so fast and cheap to use, it attracts this massive volume of experimental grassroots developers.
And Toshi recognized that volume. They positioned themselves as the foundational layer, catching all of that transactional activity.
Okay, but a thriving digital economy requires governance, right? Somebody has to steer the ship.
It does. And Toshi operates as a DAO, a decentralized autonomous organization.
Which they call the MEOW DAO.
Yeah.
Which, I mean, admittedly sounds like a complete parody.
It really does. But the sources outline a highly structured, four-phase decentralization roadmap, actually moving from team-led proposals toward total community autonomy.
And part of managing that community identity revolves around their NFT ecosystem.
Right. They initially released NFT 1.0, which was a collection of 3,000 unique digital assets minted entirely for free by early token holders.
And they didn't stop there. They later followed that up with NFT 2.0. They completely overhauled the visual artwork and expanded it to 5,000 assets actively trading on the Magic Eden marketplace.
They even integrated a gamified mechanism called Toshi Mart.
Like Pokemon, but with cats.
Pretty much. It's an NFT project where the mechanics create a self-sustaining financial loop. When a user buys a pack of Toshi Mart digital cards, 10% of those sales are automatically routed to purchase liquidity pool tokens.
Oh, that's clever.
Yeah, and then those tokens are locked and distributed back to the community as game prizes over a 5-year period.
So it creates a constant programmatic flow of capital right back into the project's foundational liquidity.
Exactly. But the governance side of the MEOW DAO is where the structural friction usually occurs in these types of projects.
Which is exactly where I need to push back on this.
Okay, let's hear it.
We're talking about retail investors, many of whom are buying a literal cat coin on their phones during their lunch break.
True.
Are we really supposed to believe that they are diligently reading 40-page governance proposals about liquidity routing and marketing budgets?
Probably not.
Right. And wait, the sources mention something called the Toshi Council. I mean, that just sounds like centralization with extra steps. Aren't we just back to a corporate board of directors at that point?
Yeah.
The whole point of crypto is supposed to be decentralization.
Your skepticism is entirely warranted there. Historically, voter participation rates in crypto DAOs are notoriously abysmal.
It's usually like 1% or something.
Right, and it leads to total structural paralysis. Imagine a project needs to spend $5,000 on a marketing campaign, but it takes 3 weeks just to reach a quorum of voters to approve the transaction.
The market moves too fast for that.
Way too fast. So the Toshi Council is an intentional compromise.
So they gave up on total decentralization to actually get things done.
Yeah, they implemented a hybrid model. The council consists of highly trusted community members who are elected by the token holders.
Okay.
And these individuals are given specific operational budgets and the autonomy to lead initiatives without putting every single micro decision to a network-wide vote.
It prevents the gridlock that suffocates pure DAOs.
Exactly. It is a pragmatic acknowledgement that competing in a fast-paced market requires agile execution, even if it sacrifices a degree of ideological purity.
Well, having an agile leadership team is probably the only way you pull off what happens next in this story. Because building developer tools in the browser is one thing.
Sure.
Breaking out of the digital ecosystem and into the physical world is another entirely. The sources highlight Toshi's really aggressive push into the DePIN sector.
Yeah, DePIN stands for Decentralized Physical Infrastructure Networks. And in July 2025, Toshi announced a partnership with World Mobile to launch Toshi Mobile.
Which is an actual decentralized mobile phone service.
It really is.
But how does a digital token running on a blockchain actually connect a physical phone call or load a web page on a smartphone?
Right, so it utilizes an MVNO model. That's a mobile virtual network operator.
Okay, how does that work?
Well, in the traditional telecom world, companies like Mint Mobile, they don't own physical cell towers. They just rent bandwidth from major players like T-Mobile.
Oh, right.
So Toshi Mobile operates as a decentralized MVNO. They utilize World Mobile's underlying global physical infrastructure, their literal towers and nodes.
But the crypto part comes in where?
The payment routing, the user identity verification, and the billing are entirely handled on the blockchain. Users can pay for their mobile data and their phone calls using TSHI tokens.
Think about your current cell phone bill right now. Every month, you pay a legacy telecom giant like AT&T or Verizon.
Yeah, we all do.
They take your money, they monetize your user data, and all the generated profit is routed upwards to their corporate shareholders. But with Toshi Mobile, you are paying a community-owned network. The underlying economic value of your mobile usage, stays within the ecosystem that you are actively participating in.
It's a radical shift in how we conceive of infrastructure ownership. Online communities generate massive, massive amounts of economic energy, but historically, they lack the tools to capture it.
And that real-world integration loops perfectly back to where we started this deep dive, in Dubai.
The crypto hospitality movement.
Right. High-end hotels and restaurants integrating a pay with Toshi QR code system. The economic loop just fully closes.
It's pretty amazing.
You launch a token, you build tools to generate revenue, you create a cellular network to handle the data, and then you use that exact same token to pay for a physical hotel room.
It demonstrates extraordinary utility density.
Look.
But before we declare this a flawless victory for decentralized infrastructure, we have to ground this narrative in the brutal, really unforgiving realities of the cryptocurrency market.
Let's talk about the price action, because gravity always wins in the end.
Oh, well.
The market history of Toshi is a textbook boom and bust cycle, isn't it?
Yeah, it really is. In January 2025, the token reached an all-time high of roughly 0.00023.
Okay.
And this massive surge in valuation was not primarily driven by the underlying utility we just discussed.
Really?
No, it was driven by institutional visibility. Toshi was officially added to the Coinbase listing roadmap, and the anticipation of that centralized exchange access just created this immense speculative frenzy.
But the broader market conditions shifted, because by mid-2026, the token had suffered a devastating 85 to 90% drawdown from that peak.
Just a brutal correction.
It spent months just grinding down in the 0.0000018 to 0.0003 range. The total market capitalization fluctuated wildly, basically bouncing anywhere between $85 million and $140 million, depending on the week.
And that extreme volatility, that is the defining characteristic of this asset class. Order books are thin and sentiment changes incredibly rapidly.
But our sources also show how dramatically structural liquidity injections can alter a token's trajectory, like what happened in Asia.
Oh, right. In September 2025, Toshi successfully secured listings on 2 major South Korean cryptocurrency exchanges.
A bit and Bithum.
Yes.
The Asia market catalyst. When those listings went live, it opened the floodgates for Korean won liquidity to directly access the Toshi order books.
And the sheer volume of that fresh capital caused an immediate 80% price spike.
Which is wild. But it highlights a vulnerability, doesn't it?
It definitely does. No matter how robust the technology is, the valuation remains highly tethered to centralized exchange accessibility.
Right.
And Toshi is fighting a multi-front war. I mean, it is not an independent layer 1 blockchain like Dogecoin.
Toshi's survival is entirely dependent on the base network remaining secure and operational.
Exactly. If base fails, Toshi fails.
And even within the boundaries of the base network, the competition for community attention is fierce.
Very fierce.
You have Brett, which has historically dominated the base ecosystem purely by market capitalization, by basically leaning heavily into pure meme culture. And you also have Degen, which carved out a massive niche through really deep integration into the Farcaster decentralized social media network.
So they have real rivals. And the structural risks extend to the token distribution as well.
Tell me about that.
Despite the fair launch mechanics we praised earlier, the data shows a very high holder concentration over time. The top 100 wallets control approximately 63% of the total token supply.
Wow. So that means the actions of a tiny handful of whales can dramatically and violently impact the price for the tens of thousands of regular retail holders.
They absolutely can.
Which brings me to the most profound question we really need to answer today. We just spent this entire time dissecting how this community built mobile telecom networks, developer launch pads, smart contract lockers, a DAO council, and Dubai hospitality integrations.
Yeah, a lot of tech.
And yet, despite all that concrete functional software, the token still lost 85% of its value during the market downturn.
It did.
So does utility actually matter at all?
That is the most vital insight to extract from this whole analysis. In the short term, no.
Not at all.
In a bull market, utility barely matters. The market operates like an irrational casino, heavily driven by hype, crowd sentiment, and the anticipation of new centralized exchange listings.
Like the Binance spot listing the community continually hopes for.
Exactly. Price action is dictated almost entirely by attention in the short term.
So all this smart contracts and cellular networks are essentially pointless for the price.
Only in the short term. Here's where the concept of utility density becomes totally crucial. Utility is a long-term survival mechanism.
Okay, explain that.
When the speculative hype dies down and the bear market begins, Thousands of pure meme coins just simply bleed out. They go to zero and vanish because there is no fundamental reason for anyone to interact with the project.
Right.
But utility creates a structural floor. The Toshi Mart requires fees. The lockers lock up liquidity. The mobile network processes actual data.
So it keeps the developers actively engaged, it gives the DAO Council actual work to do, and it keeps the ecosystem breathing during a really grueling crypto winter.
Exactly the point. By surviving the winter through utility, the project ensures it is still standing and fully operational when the macroeconomic cycle shifts.
And the next bull run inevitably brings a wave of fresh attention back to the digital asset market.
He's got it.
It is an incredibly fascinating paradox to wrap our heads around. Toshi leverages the viral, lighthearted, frankly absurd branding of an internet cat meme.
Yeah, a cartoon cat.
It uses that culture to capture human attention. But beneath that colorful surface, it operates with the ruthless, methodical, strategic playbook of a Silicon Valley tech startup.
And this evolutionary leap matters to you, whether you consider yourself a crypto native or someone who simply observes technology trends from a distance.
Because it proves a concept.
Exactly. Toshi provides verifiable proof that the dividing line between internet culture and hard financial infrastructure is rapidly disappearing.
Yeah.
In the modern digital economy, community attention is a literal currency. What we are witnessing is the reality that this attention can be organized, weaponized, and harnessed to build tangible, real-world systems.
It fundamentally forces you to rethink where value actually comes from. A group of people laughing at a cat joke on the internet eventually funded the underlying infrastructure for a luxury hotel checkout in the UAE.
Which leaves us with a final, rather critical thought to ponder today.
Let's hear it.
If a decentralized community, originally gathered around a cartoon mascot, can successfully coordinate the launch of a functional mobile telecommunications network,
Yeah.
what other traditional, heavily monopolized industries are currently sitting vulnerable, just waiting to be disrupted by highly organized, well-funded internet subcultures?
That is a staggering thought to leave on. Keep an eye on the infrastructure quietly running behind the scenes of your daily life. Until next time, thanks for joining us on The Deep Dive.